broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Thursday morning, and what a day we had yesterday. And today promises to be another roller coaster of a ride. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleague Sonia and Nigel, as always. Guys, hi, good morning.
Hi, good morning, Prashant. Good morning, Nigel. And, we can wear all the green that we try to wear, but it doesn't look like it's going to reflect on the market, right? A couple of days ago, we were talking about how things are getting a bit cautious, and that has played out in its entirety. So let's see. The day is long. Doesn't look like it's going to be any good.
Well, that's right. So let's get straight then to the cues that we're tracking.
And lots to track, right?
Yeah.
So let's just quickly tell you what you need to know as we begin another session. And I'll sort of make a quick mention of what we saw yesterday, right? So there was a big sell-off on the Nifty Bank yesterday. I mean, you can use all kinds of adjectives, massive, biggest since, etc., but it was pretty large, right? 450 points in the Nifty and 2,000 points in the Nifty. We don't see that very often. We've not seen that very often at all. Now, FIIs, I'm going to start with flows, and I'll tell you why, but it's not just about India. FIIs, we got to know that sold over 10,000 crores in the cash market yesterday. That's a very large figure. It's $1.2 billion or so. But this is the fact which I think is not very well known. Exchange data shows that it is not just, and when I say exchange, I mean other markets, Asian markets, etc. It's not just India, but other emerging markets also saw very large outflows yesterday. So I'm looking at three markets, right? And all these three markets were down quite a bit. I mean, Taiwan was down sharply. The Kospi, which is Korea, was down sharply. The Hong Kong market was down sharply as well. Almost $5 billion in Asian stocks were sold between these three markets yesterday. $5 billion, one day, right? And this is the reason why I wanted to put this up front and center, that while yesterday may seem like all thanks to HDFC Bank, and it is HDFC Bank, this also has a tinge of a global emerging market outflow kind of a day. And to my mind, it looks like this was largely on account of the very sharp dollar squeeze that we saw. The dollar yesterday, as we were mentioning same time, went up just under the 200-day moving average. It was about a 0.75% jump that we had, and suddenly the first rate cut expectation was being pulled back. The quantum was being pulled back, etc., etc. So this seems more than anything just that. Previous unwinds of this scale, when I say unwinds, outflow from emerging markets have been because of specific events. It could be geopolitical, it could be a market specific, etc., etc. So I'm just saying that this was a bit of a global thing rather than just a India-related thing. Now, overnight, US equities, and I'll come back to India in just a bit. Equities are again weak, but nothing very large, 0.6% of the NASDAQ. The yields jumped. I mean, the 10-year was up 4 basis points, but the one to focus on is the immediate one, the one which actually moves in close correlation with where the Fed fund rate expectations move. That's a 2-year. The 2-year was up 14 basis points. It ended at 4.36%. Dollar index, well, it was marginally higher, but nothing very large. It's just around the 103.4 kind of levels. Now, HDFC Bank ADR, again from the overnight action, was down another 9% last night. Just 30 seconds on this. We'll have to check exactly, but remember, historically speaking, all the ADRs which trade in the US trade at a premium as compared to the cash market here. Trade absolutely flat as compared to the cash market here, zero premium. So, for example, if a stock X is trading at, 100 rupees here, it would trade at exactly almost exactly 100 rupees equivalent in dollar terms in the US. And that includes all IT names, except HDFC Bank. HDFC Bank historically has always traded at a premium of between 8 to 9% in the US as compared to what you can buy it here in India. And with this 9% fall that we've seen last night, that premium, I think, is largely gone. I mean, I think that premium should be between cash and the US ADR would be about 0.5% or so. Having said that, right, so you can at one level say that it's just the ADR premium going off, but it's still a 9% cut, which means, at least to begin the day with, you will have that impact show through. What happens later is another point, but the fact is that this will show through, at least right at the word go, after what we've seen yesterday in any case. Now, the levels on the index, the Nifty closed below the 20-day moving average yesterday for the first time since October 2023. October 2023 is when the rally began all the way to the high in December. Previous conclusive breaks of the 20-day moving average on the Nifty has resulted in between 5 and 10% falls. I looked at August 2023. I looked at 2 instances in 2022 as well. Whenever the 20-day breaks, it leads to a bit of a pullback, and the degree kind of varies. I would watch for, yesterday I said, let's watch, give it 24 hours, right? I mean, as of yesterday's close, the Nifty ended 50 points under the 20-day moving average. Is that conclusive enough on an index of 21,500? Maybe not. So give it maybe at least a day more to see if there is a possibility somehow for the market to defend this level, right? And then take a call, because if it has to go, then the downside is a bit more. I mean, at least 5% to my mind. The immediate support for the Nifty to work day to day comes in at 21,448. That's a recent swing low. After that, the next support comes in at the 40-day exponential moving average, which comes in at 21,167. These are very near-term levels. The Bank Nifty broke an important support level yesterday with a gap. It closed below the 40-day exponential moving average. The next support comes in at the 50% retracement of the October to December rally. That stands at 45,371. The next support for the Nifty Bank is the 61.8% retracement. That's even lower, which is 44,600. Those are the big golden retracement levels. And on the upside, if all of this has to be negated, which 100% it won't be, I mean, you basically got to take out the lower end of the gap, which is yesterday's high, which is 47,212. The GIFT Nifty will come up on your screen. As I said, I mean, you know, it's a big one. I mean, I think an HDFC Bank once again will play an outsized role, 200 points lower straight off. So this is that pullback that we've been kind of talking about, perhaps will come in January. There are a lot of factors at play. There was a trigger which perhaps was needed, and I think HDFC Bank is the one which is going to do it. Sonia.
Absolutely. So, you know, the big question is, has the trend changed, right? And we don't have an answer to that just yet. It's been one day of a fall. Agreed that the fall has been pretty drastic, but we had this a couple of weeks ago as well, where we saw that sort of flash fall, flash sale in the market, and then the market recovered from there. So I think the jury is still out on whether the trend has turned for the worse or not. We'll only get to know that after a couple of days. But having said all of that, yesterday was the biggest one-day fall that we saw in the market since June of 2022. So it was pretty severe in terms of a fall. The Nifty implied opening is also indicating that the fall will be about 120 points or maybe even 150 points today. Okay, now almost a 200-point fall, so it's not going to be a good opening at all. So there is definitely caution, and I suggest that the mid-caps, you know, you be a bit cautious there, because they could be a bit more vulnerable given the kind of sell-off that we've seen. Yesterday, the biggest number to watch was the FI selling over 10,000 crores of selling in a single trading day. That's not a good sign at all. Of course, DI has bought about 4,000 odd crores. There were fresh shorts in HDFC Bank yesterday. The ADR closed with a 9% cut. There was delivery-based selling of 8,000 crores in HDFC Bank in a single day. I haven't seen that in a very long time. Now, in the US markets as well, the Dow was down for the third straight day, and the US bond yield is back above the 4.1% mark. That's on the back of strong retail data, etc., that we got, but and after the recent inflation data as well. So that has led to a correction in global markets, and our market is not too far behind. So that's the number that you need to track, the US bond yield, which is now well above the 4.1% mark. Now, all eyes are on a lot of names. There's Reliance, HUL, ICICI Bank. And, you know, some of these numbers like Reliance could be weak, because the entire oil and gas space has been weak this time around. So keep an eye out on that. The best thing to do perhaps now is to just step aside in this market, be a bit cautious. There could be more shorts in the system today, but the trend has not yet changed, because it's too soon to say that. We'll have to sort of wait for a couple of days to take that call. But for now, things are definitely looking tough.
Well, you know, Sonia, it reminds me of a movie, you know, where you have the hero that's not performing. So movie, how can it be a hit?
Yeah.
You know, either the hero changes, or you have something else that changes, or the script line changes. You know, and that's the problem with HDFC, because it's such a big weight here on the Nifty. So it's going to, you know, not perform, but you know, if it just kind of stabilizes, it'll be good enough for the Nifty to at least try to claw its way back. For the time being, it's not performing at all. So that's a bit of an issue. The texture of the Nifty, though, has turned a little bit weakish in the near term, till we say get past the 20 DMA decisively and conquer that. So the texture is weak. Though the Nifty and the HDFC Bank stock, both of them are approaching very, very crucial levels. And the FNOQs that I was talking about in the last few days, the aggressive long addition, the PCR moving in one direction, well, that's returning back to sanity, which is good news. On the HDFC Bank ADR, I just want to make one point. Yesterday, it ended at around $55.5. You know, you just converted into Indian rupees. How do you do that? You multiply by the rupee, which is 83, and then, in fact, you divide by 3. If you do that, you will get a rate of 1,540. So in the past, we've seen the ADR trades at a premium of around 8 to around 10% premium in comparison to the stock listed in India. But post this particular correction, it's absolutely nullified because the ADR, if you convert it into rupee terms, it's 1,540. So maybe in fact, we're getting used to life where there's no premium that the ADR trades at in comparison to the stock price. My short point is I don't expect the HDFC Bank stock to fall as much as what the ADR did online, because I believe that this premium is going to get compressed, and it's going to get maybe at some point of time get nullified as well. So that's why I don't believe HDFC Bank will fall that much, because it's already aligned. What do the FIs do? Well, yesterday they added massive short positions and they unwound long position. So the swing factor there is 60,000 contracts. And now from being net long of close to around 70%, it's come down to around 54%. And if you pull up a chart at the start of the series, it was 84,000 long contracts. That's come down to around 20,000 contracts. So sanity is returning. Even on the PCR, 2 sessions ago, we were talking about it moving to the upper end of the band. Now it's in danger of going to the lower end of the band. And normally when the PCR moves to 0.65, we do see a bounce that comes on the Nifty. So what are the levels you're looking at? HDFC Bank, the 52-week low, 1,460. The bulls will want to defend that mark. And my gut is it'll get defended today. The other one that we're looking at on the upside is the 100 EMA on HDFC Bank. And for the Nifty, the recent swing low is 21,450. The bulls will do well to go ahead and in fact defend that mark for an intraday basis. But I don't think anyone is talking about live below the 20,800 mark, which incidentally is the 50 DMA. So it's going to be a little bit of a tricky session. My gut is that HDFC Bank doesn't fall as much as the ADR overnight because it's already aligned. And maybe the bulls will like to defend the 21,450 mark on a closing basis. For starters, Gift 50 is suggesting a big pullback of around 185 points.
Okay, well, let's see how it goes for now. It's going to be a very interesting day after that big sell-off yesterday. What happens today? We have a lot of opinion coming through this morning. First up, Surendra Goyal of Citi upgrades NBFCs to neutral. He believes that the outlook on operating leverage and benign credit costs will support the ROAs. He says Citi replaces IndusInd Bank with Chola in Citi India picks, as they think Chola can surprise positively on growth, and credit cost is likely to be contained post the H1 disappointment. They remove Federal Bank from Citi's mid-cap picks, and they already have L&T Finance as one of their top mid-cap picks. He says their December 2024 Nifty target of 22,500 at 19 times forward earnings implies an upside of 2% post a strong rally over the past 3 months.
Okay, well, let's get you some money market views. This is Parul Mittal Sinha of Stancy, who says that the USD INR has moved higher in the week in line with US dollar strength and market positioning. She expects the USD INR to head lower once positioning is clear, as positive fundamental drivers like first quarter positive seasonality and continued inflow ahead of the index inclusion remains in place. She expects the pair to trade between 82.8 to 83.3 in the dollar in the coming week.
All right, and on the bonds, she says that global bond rates moved up this week as Fed speakers pushed back against market expectations of deep rate cuts. However, she says Indian rates moved lower as December CPI and state bond issuances were lower than expected. She says the 10-year benchmark bond yields continue to trade in a tight range of 7.15 to 7.25%, and any further downtick in rates would depend on liquidity-enhancing measures from the RBI. She adds the markets will closely watch the budget outcome on the 1st of February, where the government is expected to target the FY25 fiscal deficit at 5.4% of GDP.
Well, that's the entire setup, but let's run you through the top 10 stocks that we're tracking for you. We're looking at Oracle Financial, Precall, India Bulls Housing Finance, you have Nazara Tech and Shoba. All of them will be reacting to positive news below, so 5 apiece. On the negative side, we have ICICI Pru, LTI Mindtree, Happiest Minds, NHPC, and Sun Pharma.
Okay, Dean Kim is now joining us with a quick check on things. Dean, good to have you with us here. Thank you very much for your time. Bit of a risk-off kind of phase we seem to be entering into. Dean, your view?
Yeah, certainly the S&P and the NASDAQ in the U.S. clinging on to the 21-day moving average. And the market is struggling with uncertainties related to mixed signals from both economic data and the Fed and its members. So we saw hotter than expected CPI for December, as well as resilient unemployment rate. And although the Fed stated that rates should decline this year, starting this year, we have seen more hawkish coming from other Fed members. But what we do know is that the Fed intends to cut rates this year, and the inflation as a bigger picture is coming down. So we will have to wade through the current uncertainty first before we can see more powerful uptrend, probably in the second half. So, there's a lot of things going on, like in Asia, China missed fourth quarter GDP, and that market appears to be headed lower. So they're looking at lows as going back to 2022. That's a 10% drop. So it's not unfathomable to see that kind of reaction in China. So I think we'll have to go through some murky waters before we see some stability.
Okay, we have to go through some murky waters before we see some stability. Dean, hi, good morning, and thanks for joining in. What do you do in a market like India now? It's been a great run for us, and now it's starting to pull back a bit. Till what level do you think this pullback could go to? And at what level does India become a buy again?
Yeah, so right now, India is sort of testing the 21-day moving average. We do see some support. Should we go below that 21-day moving average, we see some support, price support going back to December lows. And so that's about 2% below. And then below that, you have the rising 50-day moving average. That's about 3% below current levels. So if we can find some support, should we break the 21-day moving average? Price support it's around 70,000 in terms of sensex. Below that is the 50-day moving average. I would say if we do see a bounce off the 50-day, that would be a great buying opportunity. But let's see if we can, hold support here and sort of stabilize.
Hi, Dean. Good morning. A couple of weeks ago, we chatted about HDFC Bank, and we were talking about, I recall you saying that it's actually providing an opportunity going by the techno funda that you look at. The numbers were a little bit disappointing, and the street believes that maybe visibility ahead is a problem. How do you approach the bank? Yesterday it closed at around 1,540 Indian rupees. Today, maybe it starts off on the back foot yet again. What's your view on that one? Because you were quite optimistic about its prospects.
Yeah, the results, I thought, there were a couple points that were certainly disappointing. So the stock reacted negatively. I would say, basically we have to keep HDFC on the sideline until the stock can sort of recover the 200-day moving average. There are some other banks, in the market that looks really attractive. I think the state banks are much better picks in terms of technical setup. So you have banks like Bank of Maharashtra, as well as State Bank of India, and then the consumer finance companies continue to do well, Cholamandalam being one of them. So there's a lot of opportunities within the financial or the banking space. But HDFC, I would say, we have to be more patient.
Okay, you have to be more patient on HDFC Bank. Got it. Thanks a lot for joining in, Dean, and giving us your quick thoughts. There's a little bit more uncertainty that could come through in the market. That's the word coming in from Dean Kim. Let's take a quick break on that note. On the other side, many stocks in focus. There was large delivery-based selling in HDFC Bank as well. More on that coming up on the other side. All right, it looks like it's not going to be a great start to trade today, but we'll take it as it comes. Our research team is here to tell us about the list of top 10 stocks to watch. ICICI Prudential came out with their numbers. Let's find out how it went. Yash is here with the latest. Yash, morning.
Well, Sonia, good morning. There's just one word to describe the Q3 numbers for ICICI Prudential, and that is terrible. Essentially, if you look at the quarter, it's a miss on all three important parameters. Your annualized premium equivalent, it's a miss as per CNBC-TV18 poll. Your value of new business, it's a miss again. And margins, it's a big miss there. As far as year-on-year comparative figures are concerned, AP has grown just about 5%. Your value of new business is down 29% on a year-on-year basis, and the margins on a year-on-year basis, they've come down by about 1100 basis points or 11%. Mind you, these are not the margins of a company. This is the margin erosion which ICICI Prudential Life has seen in the current quarter. Now, as far as today's trading session is concerned, the only thing that could really save the stock as far as any negative impact is concerned is valuations. In the last 6 months, the stock is up just about 1%. It's flat. In the last 3 months and in the last 1 month, as far as valuations are concerned, it trades at 1.6 times price to embedded value.
Okay, all right. Thanks a lot for that, Yash. But let's hop across to Rima. She's here to tell us about LTI Mindtree. Rima?
Well, LTI Mindtree has reported a muted quarter, and even the management commentary in the conference call was subdued. First, in the numbers, the company has reported a constant currency revenue growth of 0.7%. This is lower than consensus expectations of about 1%. Margins too have declined by 60 basis points to 15.4%. But now here's the commentary. The company said much deeper and broad-based furloughs impacted the performance this quarter. Q4 will be similar to Q3 in terms of growth because some of the furloughs will spill into Q4 as well. Even the guidance on the margins of 17 to 18% in terms of exit margins and for FY25 has been pushed forward in the medium term because the company still needs to make investments and the top line is going to be a bit under pressure. Nuvama, post the numbers, has cut their EPS estimates by 3.2% for this year. FY25 EPS has been cut as high as 8.9%, and their target price is lower to 7,000.
Okay, bad news comes in 2s and 3s, right? Rima, hi, morning. Happiest minds, back to you.
Well, not so happy. It's a muted quarter from Happiest Minds. So constant currency revenue growth of 0.8% quarter on quarter. Year on year, it's a 9.4% revenue growth. But as you can see from that trend line, the revenue growth for the company has slowed down this quarter. Margins too have fallen by about 60 basis points on a sequential basis. And now the 9-month revenue growth stands at 11.5%, which is lower than the guidance of 12% that the company had given in the prior quarter. Back to you.
All right. And what about Oracle, Rima? How did it look?
Very strong numbers. So the company has reported a 26% revenue growth year on year and on a quarter on quarter basis. And the revenue growth for the company was stagnant around that 1,400 crore mark on a quarterly basis. But this quarter, it's jumped up to 1,820 crore. Margins too, because of the bump up in revenues, has inched up to 48% at the EBITDA level. And this is driving a 75-80% jump in the company's profitability. License sales have been very strong for the company. So it's a top-down strong quarter for Oracle Finance this time. Back to you.
Okay, all right. Rima, we'll come back to you for more a little later. But let's focus on NHPC as well. Vivek is standing by with details on this one. Vivek, hi, morning.
Well, good morning. So, Deepam has launched an OFS where the government will be paying close to 3.5% stake in case they choose to subscribe to the oversubscription or the green shoe option. So the OFS is for the total of 3.5%, where 2.5% is the base option of this particular offer for sale, and another 1% is the green shoe option if the government chooses to subscribe it. The non-retail portion of the OFS opens today. The retail portion opens tomorrow. Remember, the government owns close to 71% stake, 70.95 to be precise. Also, remember, the shares are up almost 75% in the last year, so it's a good time to pair a bit of stake as far as the government is concerned. So when you're talking about the base issue size, 2.5% of the total equity, the base issue works out to around a little over 1,650 crore. The green shoe issue size is close to 1%. That works out to around 660 crore. So the total OFS size, as far as NHPC is concerned, is over 2,300 crore. Expect a marginal downtick given the fact that it is coming at a discount.
All right, thanks a lot for that. Well, Ekta is with us to talk about Sun Pharma and why you should be looking at that this morning. Ekta, over to you.
Well, yes, the news with regards to Sun Pharma is that they are going to be buying the remaining 21.5% stake in Taro, which is an NYSE listed company, which is going to be for $43 per share. They already own 78.5% stake in the company. The closing price was 41.28 yesterday, so it's a marginal premium. So the total outflow for Sun Pharma would be $347.8 million or around 2,800 odd crores. Now the purchase price, remember, is a 48% premium to the first time that Sun had submitted of a non-binding bid, which was in May of 2023. Now, like I mentioned, Sun holds 78.5% stake in Taro. They had initially proposed to purchase the stake at $38 per barrel, $38, but now it's going to be a premium. What is going to happen is that they're going to take the company private. It's going to be a part of Sun Pharma on a consolidated basis, and it's going to be delisted from the New York Stock Exchange. Now, analysts say that largely this is a neutral development only because the street was factoring it in. They were expecting it to happen. And but the positive is that Taro has a significant amount of cash on books, which now Sun Pharma is going to get. And hence that would be the positive But today, maybe there could be a sentiment red simply because of what the market situation is.
Okay, all right. Thanks a lot for that, Ekta. Well, let's hop across to Nimesh. Nimesh, how many times do I say it? You told us first, and now it's official.
Yes.
That's about that pre-call large trade. You know, you were out, but you said, let's do that FONA, and bang on. The bulk details, they do confirm that. Go ahead.
Yes, Nigel. So the bulk details do confirm that Minda has finally exited. They've sold their entire 15% stake in pre-call. So the one-year-long battle of possible takeover finally ends with this exit now. It's positive for pre-call because that overhang is out of the way and there could be no further war in terms of pricing, or even pre-call doesn't need to buy from the open market to protect their stake. So in that way, it's a positive read-through for pre-call. Even for Minda, it's positive because with this transaction, they've done a treasury gain of little over 250 crores by selling their entire 15% stake in the open market. The good part is for pre-call, there was no big leakage, and some large marquee investors, both FIs and DIs, bought from Minda in the service block deal. So I'll go with green for both Minda as well as for pre-call after Minda exiting its entire 15% by block deal yesterday.
All right, that's a good one. Nimesh, congratulations as always. Thanks very much for that. Soba is the next one which we're focusing on. Sonal is standing by with that one. Sonal, morning.
Good morning, Prashant. Well, Sobha, the board will be meeting on 22nd of January, and this is for a fundraise, and they will be doing this fundraise via rights issue as per the release by the company. Now, remember, this is a company which has been reducing debt in last couple of quarters. Their debt stands at 1,400 crore rupees after seeing a decline of almost 1,300 crore rupees. So it's an interesting time. They're talking about a big capex, a big pipeline, so they might be needing more funds for that. And also remember, the stock is a big mover. This year itself, it's up around 30%, so it'll be in focus till the time they decide the rights issue and the amount as well.
Okay, thanks for that, Sonal. Well, let's wind this down with Upasana, who's telling us about some more stocks in the news. Upasana?
Well, first up is India Bulls Housing. The board has approved fundraising of up to 5,000 crores, and the fundraise will be via issue of equity shares or any other convertible securities via private placement basis. Next up is Nazara Tech. The board has approved fundraising of up to 250 crores via issuance of 28 lakh equity shares at 872 per share. The funds will be mainly utilized to invest in the funding requirements and growth objectives of the company for making strategic acquisitions and general corporate purposes. While marquee investors such as Nikhil Kamath, ICICI Pru Mutual Fund, Plutus Wealth to increase their stake in the company via preferential issue.
All right, that's on Nazara Tech. But let's do one thing. Let's take a quick recap of all the stocks in focus. Stocks with positive news flow. There's Oracle, Precall, India Bulls, Nazara Tech and Soba. While stocks with negative news flow, ICICI Prudential, LTI Mindtree, Happiest Mind, NHPC and Sun Pharma. But on to a CNBC exclusive now. GQG Partners Rajiv Jain remains bullish on India and sees immense potential in the India infrastructure space. They continue to like the Adani group of companies and are optimistic about the stake increase in ITC. Listen in.
We are pretty full, so I don't know, we'll double down further because we doubled down on Adani in May and June, and then we maybe triple down in August. So I think we're pretty full. So I don't know whether we'll go further from here because the numbers are actually bigger than what you're stating in terms of our investment and the profits. Yeah, so our profits are running just under 4 billion or thereabouts in the whole investment. We've actually initiated last summer in a bunch of other infra-type names, whether JSW Energy, JSW Steel, and a few others. So we do have a number of other positions which will benefit on the cement side and so on and so forth. So we are quite bullish on that side if you take a longer-term view, not just the Adani group. And I think the execution story is actually very good, which, by the way, I don't think we feel doesn't get the full day in the sun. If you look at the roads build out, railway build out, airports, privatization, so on and so forth, is actually quite dramatic versus Indian history. So ITC we owned for 2 years, by the way. So we've added a little bit last quarter. ITC we started buying almost two and a half years ago. So that's not a new position, but that's still reasonably valued. Good volume growth story. The FMCG side of ITC has come to fruition. The hotel side should continue to do well as they spin that off. So at 23 odd times earnings, we feel that's extremely attractively valued versus, Unilever, for example, 50 times plus earnings. And this is a business that will grow at close to, 14, 15%. Upside is earnings growth. So if earnings growth is low double digit in local terms, we feel that's return is going to be. we probably would not get multiple expansion. So I agree, multiple expansion wouldn't happen, but I think the earnings growth, if it's low double digits, and I think you will see in bunch of them, earnings growth could be quite significant. One thing which actually is not true is foreign inflows. Foreign inflows have been very muted in India. In fact, last 2 years, significant outflows have happened. So despite whatever happened in China, India has not been a beneficiary of that. So it's been very domestic flow story. Now, to answer your question, look, I mean, there's always election risk, but election risks are typically very short term. I mean, if I remember 2004 election, markets declined sharply for a few days and they begin to calm down. So there are a lot of checks and balances. So the election stuff doesn't bother me. But look, there's obviously execution risk in every name that we own. And that's the kind of what we call the blocking and tackling of investing. So from a macro perspective, I think it seems reasonable. Could there be external shocks to the system? Of course, they can happen. But at this point, it's hard to specifically predict what could go wrong.
Okay, well, that's a big name, a big India bull as well. Rajiv Jain, Chairman and CIO at GQG Partners, speaking with our network. We'll take a quick commercial break here, and we'll come back with Deepan Mehta, who will be with us on the other side for some stock-specific talk. Of course, HDFC Bank will be top of mind. We'll also have the management of IIFL Finance to talk to us about their third quarter performance. Stay tuned.
Welcome back. Well, HDFC Bank will continue to remain in focus today as well. Abhishek joins us to tell us more about the stock. Abhishek?
Well, if you take a look at the ADR of HDFC Bank, it declined by more than 9% in yesterday's trade after a decline of more than 6% that you saw the day before yesterday. So in terms of the delivery volume, which was around 62.75%, and total traded volume was about 8.5 crore shares, which is worth about 13,319 crore, leading to a market cap decline of more than 1 lakh crore. In terms of open interest, it was up 20.5% versus stock decline of more than 8%. If you take a look at the technical levels in terms of stock price, the stock is right now trading below 100 DMA, but slightly above 52-week low of 1,460 per share. We have a note coming in from Bernstein. They have an outperformance rating and a target price of 2,200 per share. Now, they have spoken to certain investors with respect to what are the key concerns that investors see. And, the impact of ICRR requirement and excess liquidity has led to a decline in net interest margin, which has actually surprised the investors on negative side. Q3 net interest margin was unchanged quarter on quarter despite the absence of ICRR, that is incremental CRR, and decline in LCR, that is liquidity coverage ratio, to 110% versus 121% in the previous quarter. Apart from that, the net interest margin movement actually surprised negatively given the weak deposit growth. So estimation was that net interest margin would improve. Investors have also pointed out to concern that their net interest margin didn't rise due to system-wide increase in cost of funds, or is it that the bank chose expensive liability which impacted the net interest margin? These are the two areas of concern that investors have seen for net interest margin in Q3 FY24. Other concern is that the continued weak deposit growth could actually limit the loan growth for SDFC Bank or eat into the net interest margin of SDFC Bank. So they see potential decline in earnings growth in FY25 and 26 and increased uncertainty on time needed for improvement in operating metrics like LDR, that is lending deposit ratio and net interest margin, etc., could actually weigh on the stock. Back to you.
Thanks a lot for that, Abhishek. Well, let's get in Deepan Mehta, Director at Alexa Equities, who joins us on the show. Hi, Deepan. Good morning. What do you do with HDFC Bank? One would have thought valuations were attractive, all the bad news in the price. But today you're going to be getting it at around 1,500 rupees. Would you be a buyer or would you stay away till you see some improvement in the NIMs and the operational performance?
Good morning, Nigel, and thank you for having me on your show. That's a tough one to say because all of us have been bullish on HDFC Bank, and it's been a huge underperformer. And now we have a result like this, which is I think is okay, but I think investor expectations were a bit on the higher side. But I think valuations are very undemanding from historical perspective and versus peer group companies as well. And if you have a slightly contrarian streak in your investment strategy, then I think HDFC Bank can find a way into the portfolio unless it is already there. Because most portfolios do have HDFC Bank given its track record and its massive weightage in all the indices. So from that point of view, if I already have HDFC Bank, I'm not adding at these levels. But if I don't have anything in my portfolio, then these are good levels to get some exposure to HDFC Bank. See, if you're bullish on India and you're bullish on the India story, the capital goods cycle, consumption, investment theme, if all of these things have to play out, then HDFC Bank has to do well. And it's just a matter of a quarter or two before they start to get the synergies going and start to deliver market, I would say, industry leading growth rates in terms of deposits, advances, and profits as well.
Dipan, hi, good morning. The problem is not so much related to HDFC Bank, but what the read-through will be for other banks, right? Because if this net interest margin compression that we saw, if it's a systemic issue because of the rise in the cost of funds for the industry overall, then what are we looking at in terms of other banks, ICICI Bank, Kotak Mahindra Bank? Are you expecting pressure there as well? And if you are a stockholder there, what would you do?
Yeah, good morning, Sonia. I don't think that, it's a industry-wide trend. Of course, there is a pressure on net interest margins. But look, the volume of business is growing very well for the banking industry. A lot of companies are experiencing high teens type of growth rates in advances as well as deposits. And that should cover the whatever pressure is there in the net interest margin, which means that the net interest income can still deliver very healthy growth. And I think to an extent, costs also have stabilized. And of course, most importantly, the NPA cycle has not picked up for the banking sector. So I think banks on the whole can continue to deliver same kind of growth rates we've seen in the past 3-4 quarters. So I wouldn't like to extrapolate HDFC Bank's number to the rest of the banking industry. In any case, I think Federal Bank, Bank of Maharashtra, 2 other banks which came with numbers were pretty decent.
Deepan, hi, morning. Just a few more names. One is LTI Mindtree. Lots of earnings cuts post the numbers which have come through. And of course, it'll have a rub-off on mid-cap tech maybe as well. And ICICI Pru Life, weakish numbers here, if you have a call.
Yeah, I think both numbers are more or less in line. And Prashant, this is going to be the trend, that numbers are okay, but investor expectations are on the higher side. And because of this expectation gap, you can expect a correction in stock prices. And also valuations are not really attractive. I think whether it's LTI Mindtree, which is going at premium valuations well above Infosys, TCS, and the likes, or if you look at ICICI Prudential as well. So it's just that the numbers are pretty much okay. 1 or 2 soft quarters here, they won't change the long-term fundamental trajectory of these companies. But from a risk-return profile, when you look at the margin of safety, you don't want to buy any of these 2 companies. So I would say that it's best avoidable. But these companies have been great wealth creators and are there in many portfolios. So I would want to sell also at these levels. So you could classify both of them in your portfolio as a hold.
Okay, classify in your portfolio as a hold, both of these stocks, right? I have many more questions for you, Dipan, but I'm just going to take a little bit of a breather because the IIFL Finance Management is joining us now. Their Q3 business momentum has been strong. There was a good growth in disbursals and AUM. Their asset quality has also improved. Kapish Jain, who is the president and group CFO of IIFL Finance, joins us now to discuss more on their Q3 performance. Kapish, hi, good morning, and always nice speaking to you on CNBC TV18. I wanted to talk a little bit about business momentum, which is looking quite good, right? Disbursal growth for you folks has been about 28% year on year. Tell us a little bit about what the last quarter could look like by the end of FY24 and also in the early part of FY25. What are we looking at in terms of an average disbursal growth?
So, Sonia, invariably, last quarter gets all the momentum from a business disbursement perspective. There are a lot of the cycle is with regard to events that you have, with regard to even program that you run from incentives as well. So last quarter generally gets a big momentum as well from a growth. We wouldn't be different. Even housing company, actually, if you see the trajectory over the years, it's always been like around a big number coming in the last quarter. So last quarter should give a better number as well on a similar scale that we have seen in the past. We will also be supported by the expansion that we have done. We have done a lot of branches expansion as well. In housing company, almost 2/3 of our branches came in the last 2 years. In MFI, we added 1/3 branches added in the last 12 to 18 months. All this addition of branches as well will support. Gold have stood fine with regard to gold price as well, with a double-digit growth this fiscal. So that will again help you in getting a loan growth which you're looking for across branches. And when all these branches
give us a number, Kapish. Can you give us a number, disbursal growth by the end of the year? What are you looking at? And specifically in gold loans, which has been doing very well for you, what is the kind of trajectory? What's the number for the full year and FY25?
So we grew at around 6% in the last this particular quarter. So we should be able to beat that number. It could be in a range of around 7-8% if you talk about just the gold business number. And overall should be at a similar range.
All right. Hi, Kapish. Got it. Kapish, I'm just looking at your AUM. It's around 77,000 crores approximately. Where is that number headed? And if I look at the digital loan, that's close to around 5% of your mix. Commands higher yields, I think so. So what's the target out there? Where does that number head to?
So the digital loan is at 5%. It will remain at a similar range. The growth is coming at a lower base. We have done some realignment in that business. We were offering business loan, personal loans. With the RBI new directive coming in, we are focusing more giving personal loan to our captive customers and focus more on building the business loans there as the market grows. And we also added a supply chain element there as well. So the business mix would be business loan and supply chain and a personal loan to maybe our captive customer that we have across all our businesses. The growth there would be at the mix of that business would be at a similar range. They're selling at around 5%. They would be in the 5 to 6% range. The growth is only coming with a lower base that you see.
Okay, the cost of borrowing was around 9.1% for the past quarter. How does that number move and what does it mean in terms of NIMs? So you give us the figure on cost of borrowing. What does it translate to in terms of NIMs? And the previous question on AUM, where does it head to? Say in the next 2-year target if you had to put a number out.
In the next, so I'll give you a relative comparison. Over the last 5 years, we grew at a CAGR of around 23%, right? We have seen a lot of these elements with regard to COVID, and we had some liquidity crisis coming in earlier as well, led by the issue that we had in the sector. In spite of that, we've been able to grow at that 23%. We have grown faster this particular fiscal so far, but then there could be blips which can come into the market. We really don't know. And with the uncertainty that can come in, you would still need to make yourself conservative from a growth trajectory. So our guidance to the market is that we will grow at a CAGR of around 25%, led by the branch expansion that we have done. So we're not changing that guidance, and the mix would relatively be where it is today. With regard to your question on cost of borrowing, should I continue? Yeah.
Yes, please. Cost of borrowing and NIMs.
Yeah. So our cost of borrowing actually has held well. It's grown by around 28 basis points over the last 12 months. Few elements that helped us there is we've been able to improve our credit profile from our lenders. We've expanded our borrowing and gone into overseas market as well and raised funds through ECBs and also through MFIs as well, multilateral agencies as well who have given us money. That has helped us in holding our cost of borrowing. Other avenue that comes in now is just recently, last month, we got an outlook change on our rating. We moved from a AA stable to a AA positive from leading rating agencies CRISIL. We had a similar rating that we got from India rating of AA's with a positive outlook. As you move on the rating scale, we should be able to then expand our borrowing basket further, be it for the pension funds, and maybe when the dollar market improves, we're going to get funds from dollar market as well. We have really not leveraged the short-term borrowings. Our short-term borrowing is almost close to zero, without any undue risk, without impacting your LCRs. There's avenue of opportunity to raise funds through short-term window as well from capital market. As you move up on the rating scale, you should get to monetize more of that borrowing as well, which will normalize your borrowings if in case any further impact comes from borrowing rate coming up. So we don't think that the borrowing will move up too significantly. As and when the cycle turns back, you should get benefit of an incremental borrowing coming at a lower rate as well. So therefore, the cost of borrowing should remain at a similar level. There could be 10-15 basis points here and there. Otherwise, if you see on the yield side, on the yield as well, we've been able to hold our yield well. On the gold finance, if you see, our yield have moved up by around 1.5% over 12 to 18 months. That has primarily happened because we have expanded into those markets which are relatively less competitive. And with that, you are able to then better price your assets from your customers. And because we've gone into almost like 84% of our branches are in the non-metro locations. There, you're able to then monetize a better yield for your businesses. So
got it. Yeah. All right. Kapish, thank you very much for joining us. Very exhaustive, very well explained Wish we could go on a little longer, but just a very busy morning with everything which is happening with markets. Thank you very much for joining us, and good luck for being here on CNBC TV18. As always, first up after the earnings. We'll take a quick commercial break here. The GIFT Nifty we should just put that up for those of our viewers who are just kind of tuning in. I mean, it's going to be another, maybe at least at start, a painful day with about 167, 170 odd point downtick right at the word go. Is what the GIFT Nifty is indicating. There you go, on your screen. And of course, the big culprit, once again, at least in the right of the word go, is HDFC Bank ADR. Maybe we can leave off with that. We'll take a quick commercial break. Anuj will be here with us with how he's looking at markets. So that's the focus, our technical experts, our futures and options experts, all of that coming up in a bit. Welcome back. Anuj is here with how he's looking at the markets. Anuj, good morning.
Morning, Prashant. Well, you know what? Over the last 2 months, we heard a lot of noises about how the market does not depend on FI flows anymore. Yesterday was a reminder of, how wrong that assumption is. You had 1 day of selling of 8,000 crores in HDFC Bank. And of course, FI is on 52% stake. So assuming that a lot of it was from FIIs. In fact, yesterday, FI sold about 10,500 crores. Maybe 6,000 to 7,000 crores out of that would have been in HDFC Bank. There's gross selling of about 28,000 crores. I just want to make a point on this HDFC Bank ADR, which is down another 9% yesterday. If you adjust for this 9% decline now HDFC Bank ADR is actually trading at par with the spot here. There was quite a bit of premium that HDFC Bank ADR had over the Indian market price, and now that's gone. So while yesterday it was perhaps easier to make a one-to-one correlation and say that the stock would be down 9%, today I'm not sure that HDFC Bank will follow with another 9% fall. Maybe it will be down 3-4%, but may not be all the way back, down about 9 or 10%. It's already closed at 200-day moving average. And let's see, maybe other banks will follow suit. It's tough, though, when FIs start to sell concentrated in 3 or 4 stocks. That's when you see markets like this. Of course, there's a bit of a double whammy today. The global cues are also not supportive. We have seen HDFC Bank's numbers, which is a bit of a macro trigger, which is going to derate the entire banking sector. And Bank Nifty does not have support all the way down to 200-day moving average of 44,550 now. But even globally, if you look at cues, the US bond yield is back to 4.1% after the recent inflation data that you've seen. And that also has the potential to lead to some kind of correction in the global markets. Now, coming to some numbers, if you look at what the trade setup is, there was quite a bit of selling by FIs in both index futures and stock futures, 5,000 crores in index futures and about 6,000 crores in stock futures. And out of that, there was selling both in Nifty futures and in Bank Nifty futures, 2,500 crores each. There was quite a bit of unwinding in long positions, about 34,000 contracts, and short build-up of 24,000 contracts. The India VIX has gone up to 15, and the put-call ratio has come down to 0.7 versus 1.21. The point I'm trying to make is that from being extremely overbought 2 days back, the market could get extremely oversold at open today. That may mean some kind of intraday reversal or intraday short covering rally. That, of course, does not mean that it's some kind of bottom formation. It could just be suckers rally. But the point is that the market could become extremely oversold at some point today during the intraday trade.
I remember a couple of days ago you made this point, right? You said that there's a party going on, but, sort of dance closer to the door so that you don't have to pay the bill by the end of it. And that stayed with me. So thanks for that alert. And a little bit of caution, I think, since then. I don't know if the party has ended, but it's definitely cooled off from where it was earlier.
The crazies are out.
Yeah, the crazies are out.
Anyway, I was making the point in the morning that the Nifty, as of yesterday, has ended below the 20-day moving average. And the 20-day history tells us always is a useful guide in the very near term. I mean, tactically, etc. It gives you a few percentage points at least. And that's what I want to just look at. So what I did is I looked at the previous instances of when the Nifty broke the 20-day moving average and what happened subsequently. So it's on your screen. I mean, the last drop below the 20-day was in August of 2023. The rally, of course, began in the bottom was made in October, and then we had a non-stop move, right? Back then, we had a 4% decline. So this is the level is when the Nifty broke, that 19,667 level for August 23 is when the Nifty broke the 20-day. And then I've taken from that point to the subsequent low. That's 4%. Before that, you got to go back to December 2022. That resulted in a 9% fall. September 2022, it resulted in a 5.5% pullback. And of course, April 22, you had about a 13% fall. So basically, it's a kind of a useful guide. This 20-day, especially after very sharp extensions to either side, it gives you a signal of short-term kind of moves. So I mean, 4-5%, at least in my book, is absolutely par for the course without very much really, I mean, worry in that sense. We've not had those, and that's why markets are not used to it. You just have to go back to the 2005, 2007 bull market. You had long, big declines, multiple big declines, which has not been the case. So in that sense, it's unusual. Mitesh and Sudarshan are with us with a quick check on things. Gentlemen, good morning. Great to have both of you here. Mitesh, quick thoughts on the market as we begin, and what's the trading strategy?
Good morning, Prashant. So, yesterday I was talking about the fact that we have had some kind of an island reversal pattern and the market should possibly decline from there. That's kind of played out, and we were looking at a test of around 21,500 as the minimum. Now, it looks like, we will have that today in the morning, looking at the way GIFT Nifty is placed. Then I was wondering, if we start below that or around that level, which is the next level to come into play, and that could be closer to about 21,300, 315 zone. So I think that's where, a couple of, for me, the modified moving averages are placed. And if we can hold them on a closing basis, I think this should still, this can still classify as a bigger pullback. And if we, do some consolidation around this 21,300 zone, then we might see a reversal. But in case we start breaking below that, then I think we'll have a stronger possibility of this move playing out as a correction instead of a pullback.
All right. Sudarshan is also with us. Sudarshan, at what point does this look like a correction to you? For now, of course, it's merely a pullback, right? But do you think it could get worse before it gets better?
Yeah, good morning. See, I think this is a correction now. It's not a pullback. A big gap down, then a continuation of that decline, the big moves in Bank Nifty. This is not a pullback. It's not a friendly fight. It's a correction. And once a correction starts, then we have to wait patiently for some signs that the decline is coming to an end. It's too early to have those signs. So the trade is not to trade at all. One of the advantages of being a trader is we have the option of opting out. This is a very good option for the day.
Okay, let's do one thing. Let's take a quick commercial break. On the other side of the break, we'll have the pre-opening rates. We'll have some top stock ideas from Mitesh and Sudarshan as well. Also, Nazara Tech is in focus. The board has approved a fundraising of 250 crores via the preferential issue of shares. Nitish Mittersen will be with us, the joint MD and CEO.
Co-powered by Century Ply Club Prime.
Welcome back. As promised, we have a lot of stock ideas coming for you this morning, given the kind of market volatility. Mitesh Thakkar, Sudarshan Sukhani are still with us. Sudarshan, let me come to you. In this fall, what would you pick as a buy? I mean, for the longer term and in the very medium term as well, what would you do?
Well, there are opportunities, and it's a good question. Persistent Systems is a buying opportunity. The stock has been distinctly outperforming IT as well, of course, the broad market. Buy with a stop under 75.80. Similarly, Havells has outperformed. It's not in the same category as an IT stock, but for whatever reason, is doing much better than the Nifty. Buy with a stop under 14.15. There are intraday shorts also. Ultratech Cement is an intraday short. Clear signs of distribution are visible on the chart. Intraday short with a stop above 99.80. And finally, Escorts is in a bear market. Even when the market was going up, Nifty was going up, Escorts was coming down. That's an intraday short with a stop above 29.45.
Okay, all right, got that. Mitesh, what about you? What are your picks?
A lot of sell ideas for me as well. A lot of stocks gave breakdowns and had negative crossovers. So a sell on Axis Bank with a stop at 1,095 for targets of 1,055. A sell on City Union Bank with a stop at 146.5 for a target of 139. A sell on JSW Steel with a stop at 826, and I would look for a target of around 780 or below that. and a buy on Oracle Finance with a stop below 5,000 for a target of 5,300.
Okay. All right. Got that. Thanks a lot for that, Mitesh. Well, let's get in some derivative strategies. Chandan Taparia joins us on the show. Hi, Chandan. Good morning. And first of all, wishing you, I think, a very happy birthday. I hope I got that correct. So hoping you have a good day and a good year ahead as well. But you're joining us to tell us about your derivative strategy. So please go ahead.
Thank you, Nigel, Sonia, Prasant, and thanks for birthday wishes. It means a lot. Talking about Nifty, technically it formed a bearish candle on the last trading session with multiple negative divergence on chart and mechanical indicator like RSI, stochastic, which indicates that some sort of profit booking decline could continue. On last trading session, when index corrected by more than 500 points, we have seen addition in open interest, which clearly indicates that shorts are now adding, which can drag the index towards 21,300 and lower levels. So we believe that the way FI's long short ratio fell to 54%, India VIX has spurred by around 11% to 15 marks and recent high 16.5. Put call ratio has gone to 0.70. So by looking the entire technical and the derivatives structure, we believe that some more profit booking decline could be there in the Nifty towards 21,300 to 21,200 zone. Talking about Bank Nifty index, here we have seen a breakdown. It has breached an immediate key moving averages. We have seen huge built up on short size with huge call writing at all immediate strikes. We have seen a spurt in IV of Bank Nifty, which indicates some more downside. So till it holds below 46,500, 46,750 zone, Bank Nifty has potential to retest a key level of 45,500 marks. Now talking about stock wise, recommending to buy on two long side and one short side. However, advanced decline ratio is negative, but selective CPSE stocks or IT stocks are doing well. So first trade is buy on BHEL. This stock has given a consolidation breakout. Major trend is in tech. It is making higher tops, higher bottom. And important part is the stock was resilient and holding well, especially when market is falling down, which clearly indicate the strength, and that is the reason we are recommending to buy on BHEL with a stop loss of 200 and expecting an up move towards 220 level in the counter. Second trading area, that is buy on IT Pack, that is buy on BSOP. So Birlasoft has seen positive momentum. Stock is holding well. We have seen in tech put writing and longs are already there in the counter. So recommending to buy with support of 775. Here we are expecting an up move towards 845 level. Last trading area, that is sell on UPL, one of the weakest counter, huge built up on short side. Stock is continuously making lower top, lower bottom. All set to give the fresh breakdown. So one can sell with stop loss of 563 and UPL can drip down towards 525 marks.
Got it. All right, Chandan, have a great day. Enjoy your birthday and thanks a lot for joining in. Well, for the market, doesn't look like it's going to be a good opening. In fact, the Nifty is now indicating a fall of around 170 odd points. The stocks, HDFC Bank, another 3% fall is what we're staring at this morning. LTI Mindtree is down 8%. And I also want to see what's happening with ICICI Prudential because the numbers were very weak, as our colleague was telling us a while back. It's been a miss on all parameters for ICICI Prudential, and that stock is down 10% in pre-opening. Okay, looks like we're going to have an ugly start. But let's move on. Nazara Tech is also on our radar. The company has received the board nod to raise 250 crores via preferential issue. Nitish Mitter Sen, who's the joint MD and CEO of the company, joins us now to give us more on this development. Nitish, always great speaking to you. You had an approval to raise 750 crores earlier, out of which you previously raised 500 from SBI, MF and the Kamath brothers, and now there's 250 crores. So does this mark the completion of your targeted fundraise of 750 crores? And what do you plan to do with these funds?
Yes, absolutely. So we had planned for 750 and we've closed with 760 crores. So I think more important for us is the quality of investors we've been able to bring in, especially in this last tranche of 250 crores. It has largely been subscribed by our existing investors, including Nikhil Kamath, ICICI Prudential Mutual Fund, and Lotus. So I think that's very exciting for us that our existing investors are having a lot of confidence in our strategy. In terms of usage of funds, as you know, Nazara is a profitable cash flow generating business, and therefore much of the funds will go towards new mergers and acquisitions. We built a fantastic, I would say, pipeline over the last year of opportunities that we really like, but we are diligently working on them, and in due course, we will deploy this capital for faster growth in the coming years.
Okay,
so,
all right.
Sorry, just one follow-up. So currently, what is the cash that you have? You had 1,300 crores of cash on your books as of Q2. Where does it stand at now?
So this 250 will get added to that. So we will have about 1,500 to 1,600 crores of cash on our books.
All right. Hi, Nitesh. Good morning. So you've got the ammunition now. In terms of acquisitions, could you tell us what is the potential size of the acquisition you'll be looking at, point number one? And how soon do you close it? In the next quarter, somewhere in the middle of 2024, calendar year 2024? Give us a timeline as well as the rough size of the potential acquisition you're looking at.
So we are looking at multiple acquisitions in the core gaming business of ours, in esports, in ad tech. So the 3 or 4 verticals that we operate in, we're looking at multiple acquisitions of companies that are profitable and have large growth potential. In the past also, we have acquired businesses and grown them pretty rapidly. So we hope to replicate that. In terms of scale, we would probably look at companies now having revenues of at least 100 crores at a minimum level, and which are already profitable. And in terms of timing, I think looking at our current deal pipeline, we should be in a position to close 1 or 2 deals in, I would say, Q1 of FY25.
Okay, so you're looking at acquisitions largely in the esports space, you said, and by the Q1 of FY25 is when you're looking to close a couple of deals as well. That's interesting. Can you tell us about your investment of 10.7% in Cofluence? What does that bring to the table now? And do you have any plans to perhaps hold a majority stake? What's the eventual game plan with Cofluence?
Sure. So one of the biggest challenges in gaming in recent years, especially in the last couple of years, has been around discovery of games. There are a lot of games with privacy policies kicking in. Discovering these games or marketing these games have become challenging. On the other hand, you have a large set of creators or influencers that can reach their target consumer base or their fans, and we're basically creating a smart platform that allows these influencers to push these games to their users while monetizing for themselves. So I think Cofluence is one of the leading platforms for this. They have 600,000 influencers onboarded, and we believe that jointly we can create a fantastic game discovery platform, which is promoted through social platforms, and can be very useful also for our recently launched Nazara publishing that we are doing. In terms of the stake, right now we have taken a minority stake. We will see how this partnership goes, how the synergies play out before trying to increase our stake in the business.
All right, Nitesh, you've got a good amount of cash balance. You're on the prowl. We spoke to Delta Corp a few days ago and they have that online gaming business, which is small, but they were flirting with the idea of doing an IPO. If there is any kind of, plan for them, if they were looking to exit that business, would you give it a look?
Sure, we've had many discussions in the past. We know the management there, we know Jaidev Bhai very well. At the appropriate time, we'll be happy to have a discussion with them.
But yeah, have you had any discussion till now?
Sorry, nothing as of now.
Thanks a lot, Nitesh, for joining in, and looking forward to having a chat with you post your numbers. We're going to keep that in mind. You have a good cash balance. Maybe 1 or 2 acquisitions get closed out in the first half of this calendar year itself. Wishing you a good day ahead. Well, let's get in Mitesh back with us. Mitesh, what's your 9-10 call?
Well, I'll go with a sell on JSW Steel with a target of around 780.
Thanks a lot for that. JSW Steel a sell over there. But let's talk about some more stocks in focus. Mangalam is joining in. There is a bull versus a bear call on Asian Paints. So let's get through that. Mangalam, over to you.
Let's talk about the bull and bear cases on Asian Paints. We start with the bear cases. We have Jefferies, which says that, the oligopolistic structure of the paint industry will be challenged with the entry of new players, etc. Then this despite, the company doing well in their margins as well as volumes in the third quarter itself. They have an underperformed rating with a target price of 2,500 rupees. CLSA too says that while the quarter was led by strong volume growth and margin expansion, there are no signs of growth in their new businesses, and as a result of which they've cut their EPS estimates by 1 to 6% over the next couple of years and have an underperformed rating with a target a little over 3,200 rupees. The lone bull on today's brokerage screen has HSBC with a buy call and a target price a little over 4,000 odd rupees. They say that this volume outlook has been strong, 15% CAGR over the last 4 years, and the margin expansion reassures that there is no price war in the industry yet, and as a result of which they are bullish.
Hi, thanks a lot for that. Well, Sonal is with us to tell us why you should be tracking Aarti Industries this morning. Sonal, over to you. Thank you for that. Well, Aarti Industries has won yet another long-term contract. This time around, it is for supply of a specialty chemical. It is with a conglomerate globally. They say the contract will be for supply of over 4 years, and on completion, it will have a revenue potential of around 6,000 crore rupees. Now, this has come in just after the other long-term contract of around 3,000 crore rupees that the company got like just 20 days back. The company says the customer is part of a multinational conglomerate with business interests which are diversified. The product has been an integral part of Aarti industry already, and that's why they have enough volumes available to supply to this new company. In fact, the volumes will substantially increase of this particular product over in the last 4 to 5 years it has increased, and that will continue as well. Ongoing capital expenditure program will meet the contract requirements, and that's why they do not need to put in more capex for this particular contract, and that's why they will use the existing capacity itself. So that's a positive for the company.
Okay, all right. Thanks for that, Sonal. Well, let's hop across to Yash. He's here to tell us about ICICI Prudential. Yash?
Well, Nigel, as far as the Q3 numbers for ICICI Prudential are concerned, they are very, very weak as far as the quarter is concerned. On all three important parameters, your annualized premium equivalent, value of new business and value of new business margin, it's a miss and a big miss rather as far as the margins are concerned as compared to the CNBC-TV18 poll. Even if you look at the year-on-year comparative numbers, APE has only grown at just about 5%. VNB is down about 29% as compared to last year same quarter, and margins, they are down 1100 basis points or 11%. Do remember, these are not the margins of a company, but 11% is the margin erosion which ICICI Prudential Life has seen. A few quick points to remember as far as the numbers are concerned. The margin erosion, which also the management alluded to, has come about because of 4 important reasons. Shift in product mix towards ULIPs. They are products which give you low margin. There is a shift away from protection, which gives you higher margins, and also there is more traction as far as the non-participating portfolio is concerned. The expense ratio has also gone down, which has sort of had this negative impact on the margin. One very important point which the management spoke about in the con call, which is ongoing as we speak, is that in the quarter 4, in the next quarter, they expect to have a double-digit annualized premium equivalent growth over previous year. Remember, previous year had a strong base because of the advancement of the buying of savings policies, but the management on a positive note expects to grow on a double digit over that strong base.
Right, thanks a lot for that. So that's ICICI Prudential, big mover on the downside. But on the upside, one mover that you need to look at is Oracle. We, of course, spoke about how the numbers are quite good. Rima was telling us about that. The stock is up 10% in pre-opening. The revenue growth has been very strong. I mean, 26% quarter-on-quarter growth is what the company has seen. And EBITDA has also been really steady. 47% EBITDA is what the margins that the company has reported this time. Good improvement in profitability. And that definitely is one of the stocks of the moment. It assumes even more importance in a market like this, which is under a lot of pressure. So it's bucking the trend in a big way. That's Oracle Financial for you. So that's a big stock to watch. Nazara Tech, after the management commentary, is also up about 1.5%. And NHPC has also been in the news, so do keep an eye out on that. HDFC Bank, the ADR closed 9% with 9% cuts yesterday. But as we were telling you earlier, HDFC Bank, the stock itself could be showcasing a lesser cut. So down almost about 3% or so is what we're looking at. But what do you do post the sell-off yesterday? We just have a couple of seconds before the markets open for the day. The caution continues. The mid-caps could be vulnerable, but it's also not a given that this is a trend for the market, right? We need to see a couple of more days before taking that call on whether the market has changed the trend or not. But here's the first take on the index. It's down about 130 odd points, and the sensex is also down about 460 points. So you'd have to say there's an initial gap down opening, but it's not selling off anymore as we speak. Nifty at 21,456, so 111 points now, down about 0.5%. So the cut has been restricted to 0.5% as of now. The Bank Nifty is the one that's really taking it on the chin this morning. 1%, 1.5% now. 550 points on top of the losses that we saw yesterday. LTI Mindtree is your biggest loser, down about 9%. You have Power Grid that's down about 4%. HDFC Bank continues to lose ground, so 3.5% lower there. ICICI Bank, Maruti Suzuki, BPCL, IndusInd Bank, Kotak Mahindra Bank are all under pressure right now. A couple of these consumption names are also weak. So Titan is down about 0.3%. And some more names going to pop up on your screen. What's looking good? Generally, when the market gets into risk aversion mode, pharma does well, and that's what's happening today. Apollo Hospitals, Divi's Labs, a couple of other pharma names are looking good. You even have some of the IT names that are batting for the bull. So TCS is just about holding on to the green line. Not too bad over there. Reliance, ahead of its numbers, is up about 0.6%. Numbers come out tomorrow in the evening. There's L&T that's up about 0.5%. SBI is not too bad. So, to be honest, it's not such a bad looking screen compared to what we saw yesterday. But this is only the initial moments of trade. Perhaps you could see some more selling pressure, you never know. For now, down about 150 points, a gap down opening. What happens from here would be crucial.
Well, the good news is HDFC Bank, at least it's restricting its losses to around 3.2% approximately. The point that we made earlier today is that, the ADR was down substantially yesterday. But you equate the ADR price to yesterday's close where it was more or less in line. So the premium got wiped away. And that's why earlier this morning I made this point that I don't expect HDFC Bank to fall as much. And it's down closer around 3% odd. Remember, the recent low is 1,460. So keep an eye out on that mark. The biggest loser, though, is LTIMindtree. That's getting a clunk. It's down closer to 9%. Asian Paints numbers look fairly good. Valuation's not in favor. And you have a big name, which is, Grasim, that's coming in the next few months. So that's the reason why you have Asian Paints as well. That's under some pressure. Let's talk about some of the stocks from the broader markets. Though ICICI Prudential down close to around 8% as we speak. The problem for IEX is that market coupling could come into play, and that's why that stock is down another 4%. Yesterday it was down close to 10%. Max Financial as well is down close to around 3%. Let's talk about some winners though. Aarti, well, they announced, as Sonal told us, a big order win of close to around 6,000 crores, which will be executed in the next few years. So that's bucking the trend. It's up close to around 8%. Oracle Financial in the first few minutes itself, well, that's locked in upper circuit. Temporary freeze, up close to around 10%. Indus Stars reacting to that brokerage note that we got in earlier today, where they're fairly bullish on the stock. So that's why that one as well is up close to around 2.5%. Going a little bit more into the broader market, Sanghi Industries continues to remain under pressure because the street believes that now, in fact, they'll be getting only 10% on the markup of the cost of production. And the street was estimating that maybe, in fact, they could make far more EBITDA. Because of that, yes, it was down 10%. Today it's down close to around 9.5% odd. So that's what's restricting, the move on that stock. NHPC, you have an OFS at play, so that stock's down close to around 5%. ICICI Prudential, by the way, now it's at lower circuit. 10% lower freeze is what we've seen on that name as well. And Kochi Shipyard, what do you make of that one? Continues its up move. This week it's up close to around 18%. The stock is now up close to around 5%. And Sonia, a couple of themes that have been doing well, even though the market is rocky. You have RVNL, you have IRFC. This railway theme, it continues to play out. So these stocks are in a world of their own.
And guess what? The mid-cap index is now in the green.
Yeah.
So, the market has been a buy on dips market for very long. As we've been saying, there are these days where the market falls severely. There could be a lot of volatility, no two ways about that. But it's interesting to see how there are a lot of stocks that are seeing buying interest. So not just Oracle that we spoke about. Aarti Industries on the back of that big order win is up 8% right now. And as Nigel was also pointing out, a lot of individual stocks, Realty is coming back in a big way. Soba, DB Realty and the likes are all up and about. Soba is up almost 2.5%. Paytm is up 2.5% as well. Easy Trip has been gaining a lot of ground because of the pickup that we've seen in tourism. So Easy Trip is up almost about 2% Polycab, the low that Polycab hit was 3,700 or 3,900 if I'm not wrong. Polycab is now at 4,500 today. So it's already returned about 20% since that panic sale that we had last week because of those IT, evasion, tax evasion concerns, right? The low was about 3,700 and now back at 4,500. So big moves coming into Polycab as well in the last fortnight or so. Couple of other names. Honasa is also gaining a bit of traction this morning, so 1.5% higher. And the market, like I said, initially there was a gap down opening, but that's sort of steadied itself now at 21,440 mark. Would be interesting to see how it goes.
Well, just a few points on Polycab. The reason that the stock has bounced up is prior to the correction, that's in early December, it was trading at around 36 times its forward earnings. The forward earnings assumed it goes to around 160 rupees from around 85 rupees. Post the correction, it came to around 24 times. And today, even post, the bounce up we've seen from around 3,800, around 4,500, the stock is trading at around 28 times. What works with the company is that they're talking about 20,000 crores in terms of revenues. So the street believes they're going to get there. They believe the EPS will move from around 85 rupees to around 160 rupees odd, and they've been outperforming the market. The only question mark is what will they say with regard to these IT tax rates and what kind of clarity comes out of that. But otherwise, the business is rock solid. So that's the reason why I think, that one is getting bought into as we speak. Welspun Corp, they as well won a big order early this morning. So let's see how that stock has opened up. That's one of their units in Saudi Arabia. So that's why, in fact, I think that stock as well had opened up in the green. It's still holding with a gain of close to around 2%. But, for the time being at least, the Nifty is defending the 21,400 mark, 21,450. Well, that was the swing low that we saw recently. And as we speak, we're trading a little over that mark. So, Sonia, good to see at least some kind of stability is coming in the markets. Though you have a couple of stocks that are dragging, and HDFC Bank is now hovering around that 1,500 rupees per share mark post yesterday's sharp fall. But I think we have our guest with us. Okay, I think we'll just get Anand Shah in just a bit.
Yeah, just a couple of more stocks, right? So you have Apollo Hospitals that's hit a fresh 52-week high today. Persistent Systems is at a fresh 52-week high. Oracle, of course, we spoke about endlessly. Intellect Design Arena is at a fresh 52-week high as well. And something like a Cochin Shipyard has had a fabulous run. I mean, this year it's already up 30%, Cochin Shipyard. So that one has been gaining a lot of traction. RVNL, by the way, is also up about 35% this year. So looking pretty good. There are some big India bulls in the market despite the kind of volatility that we've seen. And here's one of them. GQG Partners Rajiv Jain remains bullish on India and sees immense potential in the India infrastructure space. They continue to like the Adani group of companies and they're optimistic about the stake increase in ITC. In fact, a couple of months ago, GQG doubled down on their India investments. Listen into what they had to say.
We are pretty full, so I don't know, we'll double down further because we doubled down on Adani in May and June, and then we maybe triple down in August. So I think we're pretty full. So I don't know whether we'll go further from here because the numbers are actually bigger than what you're stating in terms of our investment and the profits. Yeah, so our profits are running just under 4 billion or thereabouts in the whole investment. We've actually initiated last summer in a bunch of other infra type names, whether JSW Energy, JSW Steel, and a few others. So we do have a number of other positions which will benefit on the cement side and so on and so forth. So we are quite bullish on that side if you take a longer term view, not just the Adani group. And I think the execution story is actually very good, which, by the way, I don't think we feel doesn't get the full day in the sun. If you look at the roads build out, railway build out, airports, privatization, so on and so forth, is actually quite dramatic versus Indian history. So ITC we owned for 2 years, by the way. So we've added a little bit last quarter. ITC we started buying almost 2.5 years ago. So that's not a new position. But that's still reasonably valued, good volume growth story. The FMCG side of ITC has come to fruition. The hotel side should continue to do well as they spin that off. So at 23 odd times earnings, we feel that's extremely attractively valued versus, Unilever, for example, 50 times plus earnings. And this is a business that will grow at close to, 14, 15%. Upside is earnings growth. So if earnings growth is low double digit in local terms, we feel that's the return is going to be. We probably would not get multiple expansion. So I agree, multiple expansion wouldn't happen. But I think the earnings growth, if it's low double digits, and I think you will see in a bunch of them, earnings growth could be quite significant. One thing which actually is not true is foreign inflows. Foreign inflows have been very muted in India. In fact, last 2 years, significant outflows have happened. So despite whatever happened in China, India has not been a beneficiary of that. So it's been a very domestic flow story. Now, to answer your question, look, I mean, there's always election risk, but election risks are typically very short term. I mean, if I remember 2004 election, markets declined sharply for a few days and they begin to calm down. So there are a lot of checks and balances. So the election stuff doesn't bother me. But look, there's obviously execution risk in every name that we own. And that's the kind of what we call the blocking and tackling of investing. So from a macro perspective, I think it seems reasonable. Could there be external shocks to the system? Of course, they can happen. But at this point, it's hard to specifically predict what could go wrong.
All right, let's also talk about Oracle Financial. Just look at the way that stock is moving 15% higher now. Reema's here to tell us what went so damn right with the numbers. Reema, over to you.
Thanks so much for that. It's a very strong performance from Oracle. And Oracle is a company which has been reporting very subdued revenue growth. Its peers like Intellect Design Arena were reporting much higher growth. So pull up that, revenue trend chart and you would see revenues for Oracle were just hovering between 1,400 and 1,500 for the last many quarters. And this quarter, you're seeing a massive 26% 26% jump on a sequential basis, with revenues coming in at 1,823 crores. So there's this big jump up in the top line, and it's courtesy license revenues. So the license revenues have seen a big bump up. Now the question is, was there any pass-through from the prior quarter? Was there a bit of a spillover which took place, which resulted in that bump up? Because of the top line beat, margins too have come in very strong. Margins for the company historically have been on the higher side. They've even gone up to levels of about 45%. But this quarter, we've seen margins in excess of 47%. And that's driving a profit number of 77% on a quarter-on-quarter basis. That's the profit jump. Oracle Finance was generally, not one of those highly traded stocks. It was never high on the investors' interest. But, now post these numbers, I think everyone's going to sit up and take notice of Oracle Finance and, try and just find out a little bit more on whether this kind of a performance is sustainable and what led to it.
Thanks a lot, Reema, for that. That's the big mover this morning. In case you missed it, that was the entire information on Oracle Finance. But Anand Shah, Head PMS and AIF Investments at ICICI Prudential AMC, joins us now. Anand, hi, good morning. Great speaking to you. This is a tricky time in the market. We saw a large sell-off yesterday. But what's your best guess on how things would play out? Do you think 2024 is going to be a tough year for equities? Or do you think that, it's going to be smooth sailing irrespective of the kind of large events that we have upon us?
I think the last year has been surprisingly good. Not many people, under the backdrop of a macro challenges that we had globally in particular, didn't expect market to do so well. But I think what has worked for the markets have been underlying earnings growth rate. I think earnings growth rate remain resilient. On the contrary, in some of the segments of the market, they're surprisingly positive also. So if you see, a lot of underperformance has been where the earnings surprise has been negative, but otherwise, given there are domestic flows also compensating for the FI outflows that we saw last year in earlier months, that has also turned. So to some extent, we have some bit of positivity from the FI flows also towards the end of the year.
All right. Hi, Anand. Good morning. Anand, I'm just looking through the portfolios. And you'll have some exposure to HDFC Bank. The market clearly wasn't impressed by the numbers. What do you do at this point of time, though? Because across portfolios, there is some exposure out there. And it's a quality bank. But in the near term, maybe earnings growth will not be as much as earlier anticipated.
No, indeed. I think we've been underweight HDFC Bank for a very long period of time. And clearly, look, while the results on the broader numbers were still comfortable, I think again, as I said, the large corrections have been because the expectations were fairly different from what actually the banks have been able to deliver. So I think we've all along were predicting that the tall task of getting the deposits would be a challenging for any bank, and that's what has been happening. The entire banking industry is today struggling to get the deposits going. The costs of deposits are not cheap anymore. You're losing CASA also to a large extent as the difference between the savings rate and the deposit rate is very high. So I think everything revolves around, for the entire banking industry, has been the cost of funds under the broader framework that the credit growth has not been extremely strong that they could pass on all the cost of funds to the borrowers. And to that extent, we should expect some bit of NIM pressures, even for the larger banking industry as well, in next couple of quarters.
Okay, by the way, the stock in focus right now is LTIMindtree. Just look at the way that stock is moving. I mean, it's down, I think, about 10% and big moves coming in terms of volumes as well. The numbers, of course, as we know, were muted, but I think the management commentary was very weak, and that's what the street doesn't like. There have been a lot of brokerages that have cut their earnings estimates as well. Nuvama has cut their FY 24, 25 and 26 CPS quite sharply. Anand, I wanted your thoughts on what's happening in the tech space, because clearly management commentary is quite cautious, across the board. Nobody is saying that spends are picking up. Everyone's very cautious to give out any kind of guidance in terms of client spends, etc. Your thoughts on, as a in your portfolio, what do you do now? Do you sort of cut back on IT? Do you churn out?
I think we've not been owning IT for the last 1.5 years in our portfolios. And yes, till till 2 days back, it would look like as if we've missed out on a big rally. But I think from a fundamental perspective, while the stocks did rally in December and early January, I think what excited the markets was the bottoming out of the pain. But my take is, I think we relative to the rest of the market, still we are more focused on domestic economy. We continue to see that there will be challenges in the international markets where most of the customers of IT sectors still. So again, there's no qualms about quality of business, cash flows, return on equities. I think what would be challenging is the growth, whereas the domestic-led sectors have been growing much faster, and that's why they've been sort of outperforming the IT sector for the last 1.5 years.
All right, Anand, give us some themes, right, in the domestic sector. There are plenty of them. There's infra, there's cement, there's realty. Give us the theme that you're most confident on.
So we've been consistently been very positive on manufacturing, B2B, and then subsequently it also benefited the manufacturing allied businesses like utilities, logistics, even corporate banks. Even if you see our banking exposure is much lesser on the retail banks, more on the corporate banks, and to a large extent even the state-owned banks is something which PSU banks also we own. So I think manufacturing and manufacturing allied had a very, very tough decade run up to 2020. And what has changed for them is actually the China factor. I think China was a large exporter of deflation, which was positive consumer businesses but negative manufacturing. That's turning. The population is aging there. The government policy is also moving from manufacturing to consumption to some extent. So all that is working in favor for many manufacturing companies outside China, be it in Vietnam, be it in Bangladesh, and now more recently also manufacturing sector in India is benefiting as the pricing pressure from China is reduced.
Okay, all right. Thanks a lot, Anand, for joining in and giving us your take on the markets as well as on how you approach various themes. Looking forward to chatting up with you in the weeks to come. But let's focus on L&T now. Analysts believe that the Red Sea conflict can have some impact on the company. According to a BNP Paribas report, the rise in ocean freight cost can have some impact on the company's near-term margins. To get more clarity on the impact of the Red Sea attacks on the company's business, Mr. Sarma, the whole-time director and senior executive VP, Energy at Larsen & Toubro, joins us on the show. Hi, Mr. Sarma. Good morning, and thanks so much for joining in. Well, could you clarify a couple of points? You'll have exposure to the Middle East, but I believe they are the safer zones. So has there been any execution problem on business or any kind of hurdle you have faced? And also, if you could tell us, freight costs have gone up because of the Red Sea conflict. Will it have an impact in the near term?
Very good. Good morning to all of you. And let me also take this opportunity to wish Happy New Year 2024.
Happy New Year, sir.
Thank you for having me here. Actually, I think I feel that headline was a little bit misplaced, because we need to understand the specifics of the business we have in the Red Sea area. Actually, just to put it in a nutshell, I think we are having a large volume of business. There are two business streams involved. One is the solar energy park we are doing for aqua power and air products for the green hydrogen. And then a very large, significant part of the business we are doing for the hydrocarbon business for Saudi Aramco. Now, in this, I think the large part of the business is for Saudi Aramco, and that is all in the eastern province. I mean, eastern province means we are far away from the conflict zone of Red Sea. We have most of our businesses in the Gulf Coast, and all the plants are located on land. And at this point in time, we see absolutely no signs of any concerns there. Business is running very normal, and there are more projects getting awarded. And most of our materials, whatever is required for the project, either is in-sourced within the country or also it is coming through the Gulf Coast, and when there's no conflict at all. Of course, the solar part is more on the West Coast in the NEOM, and that project, as you know, is for the government, PF, and it is well secured. In fact, there is a lot of activities happening. To some extent, logistic in that area, the Suez channel is impacted, no doubt. But most of our deliveries are on CIF basis. They are delivered to the site. So as such, we don't see any impact on the monetary terms. There could be some slight delay in terms of timing, obviously, because
Mr. Sarma?
the number of rates. Yeah.
Right.
Can
So,
you hear
Mr.
me?
Sarma, what you're trying to tell us is that because of the conflict that's currently underway in parts of the Middle East, it has had no impact on the execution in terms of business, point number one. And this spike in freight cost as well will not have that big impact on business. Are we getting both those 2 points correct?
That's correct. Exactly. You got it right. And I think that's the way we see it at this point in time. And I mean, as I said, I mean, for us, there is no signs of any disturbance, and everything is running quite normal. In fact, we are in the process of ramping up and increasing our resources, and we see the activities picking up. I mean, unless some major escalation happens, we don't see any impact at this point in time.
Okay, so for the Saudi Aramco project, there's no impact, but you said even the solar energy park in the West Coast, that as well is secured. So there's been no rise in freight costs over there.
Not at
Just
all.
to clarify.
Not at all. In fact, there are a lot of activities. There's increase in the activities. And just for information, I mean, there's a huge number of delegations from India are visiting NEOM because everyone sees great opportunities. So I think it's a moment to rejoice and make use of these opportunities. Of course, we have to be cautiously optimistic in terms of keep our ears to the ground, and you're watching it closely, and we have mitigations plan if required to put it in place.
Got it. Okay, that's very good to hear. Actually, it's a big relief for your shareholders that, freight costs have not gone up for you. Can you tell us where can you end FY24 with in terms of both order inflow and revenue growth? Is there an upside risk to both these levels? And, can you give us a little more clarity on how the year could end?
Yeah, actually, we are in the silent period, as you know, I mean, because this is this 1 month, I can't talk anything about the business because our board meeting is in the end of this month. So I'm kind of restricted from giving any statements, forward-looking statements at this point in time. So please apologize. I cannot answer that question.
No, that's fine. I understand completely. But there is some concern that, generally the government slows down in terms of awarding orders during election time. Is that a valid concern? And how is the situation on the ground? Without taking any numbers, just wanted to understand how the situation is.
I mean, our bid pipeline has been pretty strong, as you have seen. I think those statements had come before. And we still see that whatever bids we have submitted, I think they will continue to move forward. I mean, they don't get interrupted because of the election or whatever other reasons. So, I mean, I think, that's moving normal.
All right. Mr. Sarma, I also need to ask you about this Safania project. Various reports are saying that L&T is well placed to secure this. Could you give us your comment on that? And by when should we hear about this project getting closed out?
Well, I think there are some developments happening, and we can announce projects only when we reach a certain point of maturity in those prospects. I hope it should happen soon. I think we'll hear soon from us.
So have you all already participated, or will you all be participating? I want to know a rough timeline.
No. We have submitted the bid for Safania last year. So most of these awards, I mean, they take almost 8 to 9 months. So whatever you are hearing has been in pipeline for a long period of time, and they are part of the pipeline magnitude we spoke about. And then they are sort of getting finalized progressively. So Safania is one of those it should conclude.
By the end, sir, of this fiscal year, should we hear about it? It's been going on, as you said, for the last few months. So in the next couple of months, the outcome, do you want to give us a timeline? Sometime in February, should we hear about the outcome?
Maybe sooner, yeah.
Oh.
Okay, that's good to hear. So we can hear about the Safania update sooner than February, perhaps. Got it.
The update I said. I'm not confirming that it is an award. I'm saying that we will know where we stand within next 3-4 weeks. Yeah.
That's what I said as well, sir, that you will get an update from you in the next 3-4 weeks. Got it. Can you tell us what are the other orders in the pipeline in the GCC area for the hydrocarbon business? Are you L1 in any other orders? I mean, just trying to understand what's the visibility like.
Again, I think I can't give specifics, but generally speaking, what we are seeing is that there is a good amount of momentum still continuing. I think we spoke about that earlier also. and we are not seeing any slowdown either from Saudi Arabia or from UAE or whole of Middle East. And as I hear that there may be a lot of projects coming from Kuwait. So overall, I think it seems to be sort of like a good sort of momentum in the West Asia.
Mr. Sarma, we appreciate you joining in and clearing the air with regard to the entire conflict that's taking place in the Middle East and also in terms of business. But just I need to probe you one more thing on the Safania project. You have participated. Hopefully the outcome is within, say, the next month or so. Could you tell us the potential size of this order?
Well, I think
just a rough size, sir. We'll have to wait by to hear about the outcome. We know that you all have participated, but what is a rough size? Just broad range will do.
I mean, see, most of the projects, as you know, in the West Asia, what they are coming up these days, the tenders are quite large, so it will fall under those large categories, mega category.
Large? Can you quantify it, sir?
We have a guideline. Normally, when we announce, we sort of give a range. What is defined as large, what is defined as mega. So it will be one of those large projects.
Okay. Yeah. Can you give us, just to understand, of course, I don't want key numbers on the margins, etc., but margins have been slightly on the muted side. In terms of a timeline, when do you see a revival in margins? Can we see it FY25 onwards?
I think we'll have to take these questions and maybe in February. I'm happy to do another interview with you. But I think we should sort of, avoid discussing the financials now.
Okay, sir. We'll leave it at that then. Thank you so much for joining us. Appreciate your thoughts here on CNBC-TV18. That's L&T categorically telling us that no, they don't have any impact because of the Red Sea conflict and, they don't expect to see any kind of hit on their margins, etc. They have two business streams, the solar energy park for green hydrogen in the West Coast, which is not impacted, and the hydrocarbon business for Saudi Aramco. That, project as well is not impacted because of the Red Sea conflict. All right, let's slip into a quick break, but not before telling you that the market is still selling off. And now I think a second wave of a sell-off has come through. Look at the mid-cap index. I think half an hour ago, the mid-cap index was in the green. Now it's down almost 800 points, and we were talking about how the mid-cap index really could be vulnerable today, and that's pretty much what's happened. Almost 2% lower now on that index. Let's slip into a quick break. Don't go anywhere. We'll keep updating the markets for you minute by minute. Neeraj Kumar, the Group Chief Executive Officer and Whole-Time Director at Jindal SAW, will also be with us to discuss their Q3 earnings. Stay tuned.
Co-presented by
Well, Jindal SAW reported a rather good set of numbers. The stock, though, has seen a big run in the last 1 year or so, and that's why it's consolidating a little bit. We have Mr. Neeraj Kumar, the Group Executive Officer and Whole-Time Director of the company, who joins us on the show. Hi, Mr. Kumar. Good morning, and good to finally see you in. We have not had you on the channel for a long while, but your numbers have been looking up. As of the 9 months, you've already done more than 15,500 crores. Given that Q4 is the best, what should you end this year with? A number closer to around 22,000 crores? Is that possible? And what kind of a revenue guidance can you give us for FY25?
Good morning to all of you. Yes, for the last few quarters, every quarter we have been setting up a benchmark, and in the next quarter we have been surpassing that. We are almost certain that the fourth quarter would be better than the third quarter, as has been the case with us, because last quarter you have a lot of government contracts, the budgetary pressures. So we can expect year-end again would be a record, the best ever for Jindal SAW. You have asked about the guidance for future. You would see our current order book is about $1.4 billion. Now that's a sweet spot. That gives us enough order book, enough visibility for next few quarters, and also gives us the kind of time to execute those orders in time as the sales funnel keeps on filling. So at present, we have a momentum behind us. We are happy with our performance because the revenue is very well diversified. If you see water sector, oil and gas, industrial is very well balanced. It's also balanced on the export as well as domestic. So,
okay. Mr. Kumar, let's get a couple of numbers going then, sir. We appreciate you sounding quite optimistic about business. So a few numbers. As you said, you've got a good order book, so things should look good. And just by going by what you're saying, you're already at 15,500 crores. Quarter 4 will be better. So I'm extrapolating that number and saying that you'll do closer on 21,500, 22,000 crores. Mathematically, I think that's possible. On that sort of a base, what will you grow? Point number 1. And your margins are around 17%. A few quarters ago, they were less than 10%. What is the sustainable number out there?
Few quarters back, we were caught in a very bad commodity cycle, which is largely our raw material, which is the coal prices. They were very volatile. Iron ore prices were very volatile, which have kind of now settled and now are moving in a corridor and they are moving in a band. So the margins have improved. So we believe that our margins should stay in the vicinity of where we are. Obviously, it is caveated upon that the commodity prices or the raw material prices that we have would continue to be stable and we would not see the kind of volatility that we saw in the commodity prices last year or so.
Got it. Mr. Kumar, hi, good morning. So you spoke about how your current order book is about $1.4 billion. Can you tell us about exports? What percentage of that is coming from the export market? And are exports lucrative for you? Do you have any order visibility over there over the next 12 to 18 months?
At present, the revenue breakup, if you see between export and domestic for this quarter, it has been about 65-35. And we expect that, yes, the exports would remain, range bound between 30 and 35%. We do have a few very good orders and we expect that we would be able to execute them. The only concern which is not impacting as yet, but we do have a concern, is the conflict in the Middle East.
Yeah.
Because that might, if the shipping channel is, disturbed, so then anyway, our products don't face any risk because this is not an oil and gas or this is not a commodity. So, but if the transportation, the shipping is disrupted, then this is one risk that we are watching very closely.
Got it. So you're saying 30 to 35% currently comes from the export markets. You said you have good amount of orders. Can you just quantify what is the order book in the export market currently? And have you Yeah. Okay, fine. Got it. So 30% of it. Got it. Have you seen any rise in freight rates which has impacted your export business? And do you think that could put any pressure on margins?
Not yet, but we are watching the market very carefully.
Okay, so this 17% margin that you have delivered, it should stabilize in the vicinity, say, of around 15 to 16%, give and take everything?
Yeah, with all those uncertainties, if you factor in, we definitely should stabilize upward of
15%. So this 17.5% appears a best case scenario that has played out. And from now on, we could pull back 50-100 basis points, right?
Yes, I am only saying upward of 15. So unlikely it will go below 15, but we would try and maintain it as high as possible because now we are also getting the benefit of some of the high value add products that we are selling in Jindal Saw.
Okay,
so we have got one.
We have got one number out of the way, sir, so that's pretty good. I'm looking at your net debt. It's come down from around 5,200 crores to around 4,750 crores. So your internal cash flows have improved and that's helping you pay down some debt. Where is this number headed? Will it continue to slide down, say, in the next few months, given the kind of cash flows that you're going to generate? Will it come down further? And also, do you have a plan for a QIP? I think you have an enabling resolution. Should we hear about that in the next month or so?
Okay, you have asked two questions. The debt level will continue to taper down. That's very strictly monitored and managed. So the cash flows that we have would go towards the regular capex. We have a few projects which are essentially going to just improve the efficiency, do some capacity balancing, and the rest will go towards debt reduction. The QIP, as you have rightly picked up, is an enabling resolution. We have not put the QIP on a calendar as yet, but we have already declared to everybody, including the stock exchanges, that whenever it happens, the proceeds would be used to lighten the balance sheet, reduce the debt further. The idea is to get a light balance sheet, keep it ready, keep it prepared, the way our order book is following, the way our sales funnel is happening, if need be, because our business is such that trade finance actually runs parallel with our operations. So
if you can, sir, sure, got it. So when you say debt level will taper down, you're currently at around 4,700 odd crores. How much do you plan to bring it down to over the next, say, 18 to 24 months?
18, 24 months, we will try and bring the term debt, because see, working capital debt is, as I told you, because of the nature of our business, trade finance, it keeps on tracking, and it has a correlation to the size of business that we do. But term debt, we would definitely like to come down to, say, around 1,000 from the 1,800 that it is in the next 18 to 24 months.
Okay, Mr. Kumar, final question before we let you go. Just tracking back our last interview where you spoke about that JV you announced with Hunter, and you're in process of getting some approvals. For FY25, what can this JV contribute and at what margins? Very quickly, sir.
Okay, the JV is with Hunting Energy, which is one of the US giants premium connection. We are very satisfied and we are happy that now the API audit has been conducted. The results should be out very soon. We have not had any major comments from them. The license is getting signed, and we are also, the way the order book, the way the market looks in the first year of operation, which is 24-25, full year of operation, the JV would be profitable. It would make a positive contribution to the plant. It will make a positive contribution to the company at a PAT level.
Okay, all right. We would like the revenue number as well, but maybe that for another time. Appreciate you joining in, Mr. Kumar. Business is looking up. Only problem is the street is a little bit nervous, I think, post the recent run and because of the exposure to the Middle East as well.
Okay, just want to point out, the market, things are not looking good at all. Look at the mid-cap index, 2.5% gone now, straight off the back. The index is down 1,200 points, and this is a scary picture, actually. A lot of 10% plus falls that we're seeing. IEX is down 8%, a couple of others as well. IRCON, ICICI Pru, NHPC, NALCO. The list is pretty long. So we'll keep tracking it for you, but for now, not looking good for the market at all. But Indian steel demand will grow in double digits, and there's a strong focus by the government on infrastructure and capex across sectors. That's the word coming in from Jayant Acharya, the joint MD and CEO at JSW Steel. Speaking to Shireen Bhan at the World Economic Forum in Davos, he outlined the capacity expansion plans, and he also spoke about the company's upcoming green steel facility. Listen in.
Given the fact that you are excited about what is happening in India as well as the opportunity that it presents itself in the near term, in terms of your business, what is it going to mean? We spoke just before the year closed out, and you were confident about being able to add capacity, both from a domestic point of view as well as an export perspective. How are things shaping up in 2024?
Things are shaping up well. As I mentioned that time, I think the India demand, we believe, is going to be in double-digit numbers, possibly for the medium term. This year, we see a growth of 14% in demand in India, which is very encouraging. We see a strong focus by the government on infrastructure and the capacity and capex across sectors. So that's very good. Manufacturing is strong. We see the energy transition piece being encouraged very, very strongly by them. So solar, wind, hydro. And all of these, as we discussed the other day, require steel, and therefore a strong demand of steel is emanating. Typically, during this nation-building phase, as we call it, I think India is going to need a lot of steel. So we are adding domestic capacity, JSW, as a part of the national steel vision to reach 300 million ton of capacity. We would like to be at about 50 million ton by 2030. Our plans are more or less on track. Currently, we are commissioning a 5 million ton facility in Vijayanagar in the next few months. And we believe that the next phase of expansion in brownfield locations in India will be our next priority between Dolvi, Vijayanagar and Jharsuguda in the east.
Okay, so you gave us a 2030 outlook and you also talked about the brownfield expansion. So say by 2025, in terms of the incremental capacity that comes on stream, what could it look like?
So JSW Steel today is about 30 million tons worldwide. Out of that, 28 million plus is in India. We expect to be about 35 million ton by FY25. And the international piece stays at about 2 million odd. And we plan to grow this in 3 locations, as I was mentioning, 5 million tons each. So there'll be an additional facility which will come at Vijayanagar in south of India. There'll be one which will come in the west of India in Dolvi, and the third one will be in Jharsuguda. So this 15 million will take us to 50, and we do expect that in the next 5 to 6 years we'll be there with this capacity on ground. We are also planning to add a green steel facility, in view of the various climate challenges which we see and steps being taken by the European Union specifically. We are planning a green steel facility which will also mostly be in the west. We're considering various locations, but mostly in the west.
What's the outlook then in terms of prices and through 2024, given the supply and demand at this point in time, as well as the implications of what happens in China, whether we see a recovery that takes shape or it's going to be slower than expected? What could it do to global steel demand and pricing?
So from a supply demand perspective, I think as you mentioned, China did have a slowdown because of the property sector. But the rest of the sectors in China have done quite well, surprisingly so. And I think they have taken various initiatives to stabilize the economy. So we are seeing the steel production by and large at a similar level as last year, and the steel consumption at a similar level as last year. But the exports from China have gone up, and that is a concern. And the supply, therefore, into the world has increased. Going forward, I think this year we see, the good things are the inflation is reduced quite a bit. We see interest cuts which have already been indicated by US and by other regions as well. So that would encourage consumption and investment both, and that would require steel. A lot of rebuilding of countries and rebuilding of regions will happen. So we feel on a supply demand in the medium term it should be good. On the shorter term, I think we need to be cautious in India because India is growing. We should be wary of any unfair trade which comes into India at low prices, which would hurt us.
Well, that I think the government is always watchful for, and mechanisms are in place to impose duties as and when the government believes there to be a case. Is there a case at this point in time to be made?
There is a case growing because I think today India is a net importer in this year of steel, which is not a good thing. And what is worrisome is that some of the cheap imports are coming into India at prices which are predatory, and that is our concern. If it's fair trade, we are good to go. If it's prices which are below at times their domestic prices or at a loss, then it's a concern.
Have you taken this up with the government recently?
Yeah, we are in discussion with the government in terms of
any
steps
specific
which
products
should be taken. It is actually across various product lines, but mostly in the flat steel space.
Okay, and what is the, when you talk about predatory pricing, I mean, how predatory is it?
I think without going into numbers, over the last 3-4 months, it has been a little challenging. But I think of the last few weeks, Chinese prices have gone up. Maybe international prices has gone up as well. So Chinese prices have moved up by $40 or so. The prices are still a little on the lower side, and we understand that Chinese steel companies are probably at a loss or at a marginal cost at this level. So there is a case for us to take up with them appropriately.
All right, let's slip into a quick break on that note. On the other side, Avinash Godkhindi, the co-promoter, MD and CEO of Zaggle Prepaid Ocean Services, will be with us to discuss about their new agreement with Torrent Gas. Stay tuned.
मेरी कहानी की शुरुआत
Well, let's focus on Zaggle Prepaid Ocean Services. The company has signed a contract worth around 200 crore rupees with Torrent Gas for closed-loop card fleet royalty program. To discuss this and more with regard to that development, Mr. Avinash joins us, the co-promoter, the MD and CEO of the company as well. Hi, Avinash. Morning, and good to see you in. Well, could you give us a couple of details with this order? What does it take your total order book to? And the rough margin trajectory with regard to this order?
See, this is about a new space that we are entering into some ways with fleet. Fleet is a large opportunity globally. There are companies like FleetCor and Vex, etc., in the US, which are multi-billion-dollar companies who build a fleet business for fleet payment business for companies there, right, for corporate customers. So this is a new foray for us. It's our first fleet program, and we're very excited about the opportunity. Torrent Gas being a great name to have as a customer, and this is a program where we are running it end to end. So it's a closed loop program. So the entire program is orchestrated and run by us, and there's no bank partnership involved apart from escrow, right?
Okay. Avinash, hi, good morning. So what does this take your total order book to, and what is the kind of order visibility that you have? Any other such orders that you're looking at in 2024 itself?
Absolutely. Looking at them, there are a couple of programs that are in the works, Sonia, and overall the size of the fleet market in India is about 73,000 crores, right? That's the size of fuel consumption by fleets. And in rupees, and that's about 5.25 million metric tons of fuel, right? So the opportunity size is massive, and there are a couple of other programs as well. We don't look at it from an order book perspective. For us, it's all about the amount of fleets that we get. So there are about 500 fleets that are coming straight off board on this program. There are about 260 outlets where this card would be accepted to begin with. And to begin with, we are starting with about 3,000 cards, right? And this is only going to grow, and that's how we estimated the 200 crores GTV to begin with.
So what does this mean for your quarterly revenue run rate? I mean, currently you're, clocking in about 200 crores per quarter, thereabouts. What do you think you could do, say, over the next couple of quarters and in FY25 as well, given the new orders?
Can't quote the numbers, Sonia, but yeah, we are on track. Numbers are looking good, and we had a good uptake of spends on our cards, very good uptake of spends on our cards in the festive season, and our credit card proposition, corporate credit card and purchase card proposition, along with Zoya, which is our vendor payment platform, that has really picked up very nicely. Better than our expectations in some ways. So overall, we are very, bullish about how things are looking for us.
Good to see that you're bullish, Avinash. But what kind of a growth trajectory can you look at? Say in the next 2-3 years, you must be having some growth in mind. And also, exports is a very small proportion of your business, I think. So, but you're quite bullish on prospects out there. So, how much will it contribute?
See, exports is a greenfield area for us. We are starting off, going global in the coming quarters is what we are looking at, right? So I wouldn't want to put a number on that and bucket ourselves. We still need to do a lot of work on that front to figure out how, which markets we enter, how do we enter. There are a lot of those details that we need to firm up right now. Overall, if you look at it, this space is growing. Our business is growing very well. We are the largest in the spend management space in India. And everybody wants to digitize. Everybody wants to reduce their leakage, be more compliant. And those are the kind of solutions that we are offering to corporate customers. So our growth is in line with what we had given as a guidance in the beginning of the year.
All right. Thanks a lot for joining in, and appreciate your thoughts here on CNBC-TV18. That's Zaggle with the latest order that they got from Torrent Gas to worth 200 crores. Let's slip into a short break. The market is still down about 200 odd points. When we come back, we'll tell you what lies ahead for the construction sector. Will road contracts from the government start declining this quarter as the election code of conduct kicks in? Lata Venkatesh will be speaking to Anurag Jain, the Secretary of the Ministry of Road Transport, in just a bit. Stay tuned.
co-powered by